Hey guys, welcome back to the Bitcoin Fortress podcast. Today is June 7th, 2026. We are at block height 952742. Moscow time is 1608 sats per dollar, and fees are sitting at 1, 1, and 2. This was one of those weeks where Bitcoin forced everyone to check their conviction. Price got hit hard. ETF flows flipped from support to pressure. Strategy made a symbolic sale. Treasury company stocks got punished. Macro conditions tightened, and the financial media immediately started writing Bitcoin's obituary again. But here at Bitcoin Fortress, we are not here to chase the candles or narrate every panic tick. We're here to understand the structure underneath the move. The question is not, did Bitcoin have a bad week? It did. The better question is, what did this week reveal? It revealed that ETF demand is real but not permanent. It revealed that leveraged Bitcoin Treasury strategies can face stress. It revealed that macro liquidity still matters. It revealed that Bitcoin miners keep securing the network even when price is ugly, and it also revealed that Bitcoin does not offer emotional comfort. It offers monetary truth. And so with that, let's get right into it. Starting with market structure, price, ETF flows, and the crazy week without the CNBC breathless panic. Bitcoin revisited the low 60K area, but the institutional mood is different this time. CoinDesk framed the key distinction well. Bitcoin near 60,000 today is not the same as Bitcoin near 60,000 earlier this year because ETF flow behavior has changed. In February, institutions slowed their selling near that level. This time, ETF holders were selling into weakness. That matters because it suggests the market is not just reacting to a chart level, it is repricing liquidity, risk appetite, and institutional patience. The interesting thing is not the price itself. Bitcoin is traded through terrifying drawdowns many times. The interesting thing is the composition of marginal demand. ETFs made Bitcoin easier to buy, but they also made Bitcoin easier to sell. That does not invalidate the ETF thesis. It simply means ETF holders are not all long-term Bitcoiners. Some are portfolio allocators, some are tactical macro traders, and some are tourists. And probably a lot of them are chasing the AI. So it's a capital rotation too. Cointelegraph reported that US-listed spot Bitcoin ETFs extended their outflow streak to 13 trading days with roughly $4.4 billion withdrawn during the run. Bitcoin fell about 21% from mid-May levels during that same stretch. This is why ETF adoption cuts both ways. ETFs absorb supply during risk-on periods, but they can also become a high-speed redemption rail during risk-off periods. For Bitcoiners, the lesson is simple. Paper wrappers do not change Bitcoin's monetary policy. They change access, liquidity, and volatility transmission. Bitcoin Magazine cited approximately $2.3 billion in cumulative spot ETF outflows for May, calling it the worst month of 2026 for the product set. The key here is not to overreact. ETFs are a demand channel, not Bitcoin itself. A bad ETF month does not mean the network failed. It means one class of marginal buyer became a marginal seller. That's important, but not existential. Reuters reported that stocks fell sharply after stronger than expected U.S. jobs data increased fears of a Fed rate hike, with tech stocks under pressure and investors defensive ahead of the weekend. This is the liquidity still matters segment. Bitcoin is hard money, but it trades in a world dominated by credit, leverage, collateral, and risk models. When long rates rise and the market starts pricing tighter policy, high duration and non-yielding assets get hit. Bitcoin is not immune to that in the short run, The long-term thesis is that Bitcoin is the exit from the system, but the short-term price still lives inside the system. CoinDesk reported that the U.S. economy added 172,000 jobs in May versus expectations of 85,000, while the 10-year Treasury yield jumped to 4.52% after this report. Bitcoin remained lower near 61,900. This is the heart of the week. Bitcoin did not fall because Bitcoin stopped working. It fell because the market repriced the cost of money. Higher Treasury yields raise the opportunity cost of holding assets that do not generate cash flow. That does not make Bitcoin inferior. It just explains why the fiat liquidity cycle still drives short-term market behavior. Next up, strategy, Treasury companies, and the never sell stress test. Bitcoin Magazine reported that Strategy sold 32 Bitcoin between May 26th and May 31st at an average price of $77,135, raising about $2.5 million to fund distributions on Stretch preferred stock. 32 Bitcoin is tiny relative to Strategy's stack, but symbolism matters. Sailors spent years hammering the never sell your Bitcoin meme into the culture. So when Strategy sells even a tiny amount, the market does not interpret it mathematically. It interprets it narratively. The real story is not that Strategy abandoned Bitcoin. The real story is that once you wrap Bitcoin in corporate finance, preferred dividends, leverage, and market expectations, you introduce obligations that pure cold storage does not have. The Wall Street Journal reported that Strategy sold Bitcoin for the first time since 2022 while still holding roughly 843,706 Bitcoin. The sale was tied to preferred stock dividend funding. This is a good moment to separate Bitcoin from Bitcoin financial engineering. Bitcoin has no debt. Bitcoin has no dividend obligation. Bitcoin has no quarterly earnings call, but a company using Bitcoin as collateral inside capital markets does. That can be powerful, but it is not the same risk profile as self-custody. Payments summarized a Bloomberg-linked report noting that digital asset treasury stocks suffered deeper losses than Bitcoin, with Strategy's sale helping pressure sentiment. This is exactly what should happen in stress. Treasury companies are not Bitcoin. They are leveraged or equity-wrapped claims around Bitcoin, plus management, capital structure, dilution, debt, preferreds, and market premium or discount. In bull markets, that can amplify upside. In drawdowns, it can amplify pain. Investors Business Daily reported that Strategy's Bitcoin slide could raise the dividend rate on its Stretch preferred stock from 11.5% to at least 11.75% and potentially higher. Actually, I just checked this morning, it's over 12 if the preferred trades below certain levels. This is the digital credit stress test. Bitcoin-backed corporate finance is fascinating, but it has to survive bear markets. The question is not whether Bitcoin is good collateral. It is whether the capital structure built around that collateral is resilient when price falls, equity weakens, and financing costs rise. And so we shall see. Bitcoin Magazine reported that Strive acquired 2,500 Bitcoin for roughly $185.2 million at an average price of $74,092, bringing its holdings to 19,000 Bitcoin. This is the counterpoint. One treasury company sold a tiny amount for financing reasons. Another bought aggressively into weakness. That tells you the corporate Bitcoin treasury trade is not dead. It is maturing. The next phase will separate disciplined balance sheet allocators from companies that are just chasing the strategy template. BitcoinTreasuries.net lists Strategy at 843,706 Bitcoin, 21 Capital at 43,514 Bitcoin, Metaplanet at 40,177 Bitcoin, Mara at 35,303 Bitcoin, and multiple other public Treasury holders below them. This is no longer just MicroStrategy and everybody else. It's becoming a sector, but that also means investors need to analyze these companies as companies, not just as Bitcoin proxies. Moving on to policy and regulation. The Senate Banking Committee announced on May 14th that it advanced H.R. 3633, the Digital Asset Market Clarity Act of 2025, in a bipartisan markup. The bill is designed to create clear rules of the road for digital assets. For Bitcoiners, clarity is not about needing permission for Bitcoin to exist. Bitcoin already exists, but legal clarity affects exchanges, custodians, ETFs, corporate adoption, stablecoin rails, tax compliance, and how capital enters the ecosystem. The risk is that the market structure law benefits the regulated wrapper layer more than the sovereign user layer, so the Bitcoiner position should be yes to clarity, no to capture. Treasury's April 2026 release on Genius Act implementation said permitted payment stablecoin issuers would be treated as financial institutions for Bank Secrecy Act purposes and would face AML and sanctions compliance obligations. Stablecoins are not Bitcoin, but they matter because they reinforce dollar rails inside crypto markets. Stablecoins may strengthen the dollar system even as Bitcoin offers an exit from it. That is the paradox. The same digital asset infrastructure can expand fiat reach and Bitcoin adoption at the same time. Thomson Reuters reported that crypto tax legislation may move independently from broader market structure law, with tax consequences still unsettled as Congress weighs competing digital asset frameworks. This is some practical news for all of us. Regulation is not just SEC versus CFTC. The real life friction is tax reporting, basis tracking, charitable giving, mining income, staking rules, ETF treatment, and compliance complexity. Bitcoiners should watch the tax track separately because it directly affects you, but only if you're selling. Buy and hold. Next up, mining, network fundamentals, and self-sovereignty. Hashrate Index's June 1st roundup said Bitcoin was down while hash rate difficulty and fees were up, leaving hash price lower. Miners collected about 3,173 Bitcoin in block rewards over the prior week, with fees making up only 0.74% of rewards. This is Bitcoin's brutal beauty. The network does not care about ETF flows, blocks keep coming, difficulty adjusts, miners compete, weak miners get squeezed, strong miners survive. Bitcoin's issuance schedule remains indifferent to Wall Street's mood. Coin Wars showed Bitcoin difficulty around 138.96 trillion at block 952,741. Price gets all the attention, but difficulty is the quiet signal. A high difficulty environment means miners are still committing enormous real-world energy and capital to secure the network. That does not guarantee price goes up tomorrow, but it reinforces that the base layer remains alive, competitive, and expensive to attack. And that's what matters. Bitcoin Magazine published a practical 2026 privacy guide highlighting tools such as Sparrow Wallet, BISC, and Bolts, while also warning about CoinJoin trade-offs and exchange surveillance. This belongs in the show because privacy is not a niche hobby. It is basic financial hygiene. ETFs and regulated custodians are great for access, but they do not replace sovereign usage. If Bitcoin becomes only a brokerage asset, we lose something essential. All right, moving along to the podcast universe themes from the week. Theme A, Bitcoin 2026 Aftermath, Policy, Institutions, and Infrastructure. Bitcoin Magazine's podcast feed is still digesting Bitcoin 2026 with recent episodes covering policy, quantum debate, stablecoins, and Bitcoin infrastructure. Deezer's episode listing shows the quantum debate dominates Bitcoin 2026. Nick Bhatia, stablecoins are a Trojan horse for Bitcoin, and other Bitcoin Policy Hour episodes. The conference afterglow was not just bullish vibes. The themes were institutionalization, regulation, quantum readiness, privacy, digital credit, and whether Bitcoin can scale its financial footprint without compromising the base layer. The next theme, digital credit and Bitcoin-backed lending. Bitcoin Magazine's Spotify listing shows Brandon Green sitting down with Salt Lending CEO Sean Owen from Bitcoin 2026 to discuss the digital credit revolution and Bitcoin-backed credit. This pairs perfectly with the strategy stretch discussion. Bitcoin credit is not just coming, it's here. The question is whether it is built prudently or whether it recreates fiat leverage games using better collateral. And the third theme is human connection and media in the AI age. A Bitcoin 2026 talk titled Why You Need to Start a Podcast framed podcasting as more important in a world where AI commoditizes labor and human connection becomes scarcer. Bitcoin media matters because trust cannot be fully automated. People still need voices they know, filters they respect, and signal through the noise. Moving along to the featured Substack segment, featured post is A Bitcoin Way of Life, Week 3. This week's featured essay is part of A Bitcoin Way of Life. The core idea is that Bitcoin is not just an asset allocation, it becomes a discipline. It changes how you think about time, work, consumption, savings, and responsibility. This connects directly to the week we just had. When price falls, the speculator asks, am I losing? The Bitcoiner asks, has this thesis changed? And if the answer is no, then a down week becomes a test of temperament. Bitcoin teaches patience because it punishes leverage, emotional trading, and short-term thinking. It rewards people who can lower their time preference and live with volatility without letting volatility define them. Did want to mention my 4 Bitcoin Fortress books, links in the show notes to these, as well as all of the articles that we reviewed today. If you want to go deeper into the ideas behind this show, I do have 4 books available. The beginner book is for people just starting out. The retirement and estate planning book is for people thinking seriously about long-term wealth, inheritance, custody, taxes, and legacy. The Bitcoin lifestyle is about how Bitcoin changes the way you live. And the new one, The Architecture of Money, is about the deeper monetary system, how the old architecture works, and why it is failing, and why Bitcoin represents something fundamentally different. Well, folks, that is it for episode 219 of the Bitcoin Fortress podcast. I'm not going to lie, this was a rough week in the market, but maybe a useful one. It reminded us that Bitcoin is not a straight line. ETFs can sell. Treasury companies can face stress. Macro could tighten. Narratives can flip overnight. But you know what? The blocks keep coming. Bitcoin does not need anyone's mood to be good. It does not need the Fed to cut rates. It does not need CNBC to approve. It does not need politicians to understand it, and it does not need every ETF holder to have conviction. Bitcoin just needs to keep doing what it does, issue on schedule, settle without permission, and offer a monetary escape hatch to anyone willing to learn how to use it. Stay humble, stack sats, verify everything, and build your fortress. And with that, I will see you all next week. Bye-bye.